Let's set the scene. The date is October 24th, 2025, and on Wall Street, something big is happening. We're talking about a golden rally that didn't just break records, it absolutely obliterated them, pushing the U.S. stock market to heights we've never seen before. Welcome to The Explainer. Today, we are diving deep into that incredible market surge on Friday, October 24th, 2025. You know, this wasn't just another good day. This was a day for the history books. Just take a look at the scoreboard here. It was a total clean sweep. All three major U.S. indices hitting brand new all-time highs. The tech-heavy NASDAQ was on an absolute tear, up over 1%. And the Dow Jones, well, it just casually smashed right through the 47,000 mark for the very first time. Incredible stuff. So, if we boil this entire day down, what's the real story? Well, it's this fascinating push and pull. On one hand, you've got this incredible optimism, this golden combination of a really strong economy and the promise of interest rate cuts on the horizon. That almost never happens. But on the other hand, you've got some very serious alarm bells going off, with analysts warning that valuations are sky high and that we might be in a very, very bubbly market. Okay, so let's dig in. What exactly was the rocket fuel that launched this rally into the stratosphere? Well, the single biggest catalyst of the day was the release of a huge economic report on inflation. I'm talking about the Consumer Price Index, or the CPI. Just think of it as a report card for the prices you and I pay for, a whole basket of goods and services. And the number came in at exactly 3.0% for September. Now, that was just a little bit below the 3.1% that all the experts were expecting. And that tiny difference? Well, for Wall Street, that was a massive, massive win. It was the signal they were desperate for, proof that inflation is finally really cooling off. But here's the thing, it wasn't just that one inflation number. It was like a perfect storm of good news. You had growing chatter that the Fed might end its quantitative tightening policy, which could mean more money flowing into the system. You had some real optimism around upcoming US-China trade talks. Plus, strong economic data from the S&P Global PMI report showed businesses are healthy. And as the cherry on top, everyone was bracing for monster earnings reports from big tech. It all adds up to what investors call a no-recession rate cut scenario. It's this incredibly rare sweet spot where the economy is strong, but the Fed is still expected to make borrowing cheaper. It's the best of both worlds, really. It brings to mind what the famous investor Mark Minervini always says, don't fight the Fed and don't fight the trend. And right now, it seems like investors are jumping in with both feet. Okay, so we've seen the big picture, but how did all this optimism actually translate to individual companies? Let's look at some of the day's biggest winners and losers. And this is where the story gets really interesting. You see a clear divide. On one side, you have companies like Ford and Intel soaring, up 12% and 8% respectively on news of strong production and profits. Then you have Coinbase and IBM also having great days. But then look at Deckers, the company behind Ugg and Hoka shoes. Their stock plummeted 15%. Why? Because their guidance was weak. It's a huge warning sign that even with the market roaring, the average consumer might be starting to pull back on their spending. Right, so given this really complex picture, a booming market, but with some clear warning signs, how should an investor approach this? What's the playbook from here? Well, analysts basically see three main scenarios playing out, and each one suggests a pretty different strategy. Let's break them down. First, if you think this golden rally is just getting started, the play is to stick with what's working, large-cap tech and the whole AI theme. The second path is the liquidity play. This is a bet that if the Fed does start pumping more money into the economy, it'll lift all boats, especially smaller companies that have been left behind. And the third option? The defensive hedge. This is for the cautious investor who's worried about a correction and wants to protect their portfolio with something like gold. Okay, which brings us to the big final takeaway. How do we think about the risks here in what some people are calling a dangerously bubbly market? And listen, it's not just a few people saying this. David Kelly over at JP Morgan Asset Management is asking a really critical question. He's saying the market is already very highly valued, some would say bubbly. So why in the world would the Fed want to add more froth to it by cutting rates? It's a great point. And to put that bubbly comment into perspective, look at this chart. It's one of the key ways we measure how expensive the market is. Right now, the total value of the stock market is 365% of the entire U.S. economy's output. Now compare that to the peak of the dot-com bubble in 2000. Back then, it was only 212%. So yeah, by this yardstick, we are in much frothier territory today.
So as we wrap this up, there are two crucial risks that you really need to keep on your radar.
First, this inflation problem might be stickier than today's good number suggests. There's a key survey out there that shows people's long-term inflation expectations are actually rising to 3.9%. That is nearly double the Fed's 2% target. It suggests this fight isn't over by a long shot.
And the second major risk? The AI boom itself is being fueled by an absolutely massive amount of corporate debt. I mean, look at Oracle's plan to sell a record-breaking $38 billion in bonds. It just shows that this whole AI revolution is being bankrolled by borrowed money, and that creates a huge potential risk if this cycle ever turns.
So I guess that leaves us with the ultimate question, doesn't it? Is this market's golden rally a historic opportunity that's powered by real, fundamental strength? Or is it a golden trap, fueled by hype and speculation, just waiting to snap shut? That's the billion-dollar question.